2,134 points. That is the staggering drop the Nikkei index suffered in just a single trading session. And this happened right alongside a brutal 5% plunge in the closely watched semiconductor index. The market is facing a severe reality check right now, and the damage across the global technology sector, well, it's deepening.
Hello everyone, welcome back to AI Market News.
Based on available data, the broader U.S. markets are being dragged further and further away from those recent record highs. The S&P 500 fell 0.69% to 7,692, marking its third consecutive decline, while the Dow slipped 0.22% to 53,343. But as you can see in the chart, if you look at that steep downward trend on the right side, it's the technology sector taking the absolute heaviest damage. The Nasdaq bore the brunt of this sell-off, dropping 1.33% to close at 26,290. This downward momentum really reflects a growing unease, underscored by the VIX Fear Index bumping up 4.3% to 15.84. So we're witnessing a very clear retreat from risk across the board.
And the pain was definitely most acute in the specialized tech space. The Philadelphia Semiconductor Index, commonly known as the SOX, plunged roughly 5%. This is a huge blow to the chip sector, which, as we know, has been the primary engine of our recent bull market. And it wasn't just the mega-cap names getting hit. AI-adjacent chip makers and supply chain partners like Wolfspeed and Fabrinet saw sharp, immediate declines. The underlying mechanism here is absolutely crucial for all of us to grasp. High-growth semiconductor and AI companies are priced based on massive future earnings expectations. So when broader macroeconomic conditions tighten, investors rush to reprice that future growth, and that leads to these aggressive sell-offs we're seeing.
The catalyst for this correction is the exact same toxic macroeconomic cocktail that's been pressuring markets all week. While you see the Nasdaq declining on the left, look at the 10-year U.S. Treasury yield over on the right. It's settling around a very elevated 4.69%. Meanwhile, the 30-year Treasury yield is hovering near its highest point in 19 years. The mechanism driving this inverse relationship is actually pretty simple. Rising bond yields make high-growth AI stocks look increasingly expensive and honestly a lot less attractive to all of us. I mean, why tape on the wild volatility of the stock market when perfectly safe, guaranteed returns of nearly 4.7% can be found in U.S. government debt? This rising risk-free rate is literally acting like gravity on those sky-high AI valuations.
The other half of this restrictive environment is energy. Crude oil WTI remains highly elevated, primarily stemming from the ongoing standoff and geopolitical tensions in the Middle East. For all of us monitoring the global economy, elevated oil prices are a major red flag. Why? Because energy costs filter into absolutely everything, from manufacturing to transportation. The underlying fear here is that these higher oil prices are going to feed directly into consumer prices. That means inflation will remain stickier than we originally hoped, which effectively forces central banks to keep interest rates higher for a longer period of time.
We can already see the real-world impact of these elevated rates in the latest U.S. economic indicators. Data released Tuesday showed a mixed picture in the housing sector. July housing starts plunged 12.4% to an annualized rate of 1.239 million units. That falls well below the 1.35 million consensus. Single-family starts specifically dropped 9.9%. The mechanism here is direct. Elevated mortgage rates continue to choke residential construction because they make financing just way too expensive for both builders and buyers. However, it wasn't all bad news. Building permits actually rose 5.0% to 1.443 million, which beat expectations. This suggests that while current construction is stalling out, some forward-looking demand remains intact for when rates eventually normalize.
Now, the ripples of this shifting macro environment hit Asian markets exceptionally hard. Over in Japan, the Nikkei suffered a brutal session, falling that staggering 2,134 points, or 3.2%, to close at 65,326. The relentless selling pressure is clearly visible on the chart here, bringing the total two-day loss for the index to roughly 3,900 points. That is a massive 5.6% slide in just 48 hours. We're talking about a severe recalibration of risk for Japanese equities.
The selling in Tokyo was highly concentrated in the exact same AI and semiconductor names that are struggling on Wall Street. SoftBank Group dropped a massive 10.3%. Memory chip maker Kioxia fell 12.6%, and Furukawa Electric lost 13.7%. This mirrors the pattern we're seeing in the U.S. markets. Adding to the pressure domestically, let's transition over to the bond market for a second. Japanese government bond yields briefly touched a 30-year high of 2.945% earlier in the week.
Yields only eased back to around 2.9% today, entirely based on market expectations that the Japanese government might intervene in the bond market to stabilize prices.
For all of us managing cross-border exposure, the currency markets are reflecting this exact tension, with the USDJPY pair hovering right near 159.094. The underlying mechanism driving this critical exchange rate is the shifting dynamic between US and Japanese bond yields. Even though Japanese yields touched a 30-year high, they're still vastly lower than the nearly 4.7% offered by US Treasuries. So as long as this massive yield differential exists, capital tends to flow straight out of the yen and into the dollar to capture those higher risk-free US returns, and that keeps the yen structurally weak.
Which brings us to the most critical catalyst of the week, tonight's release of the FOMC minutes at 2 p.m. ET. We'll be looking closely at the split vote in July to see what specific conditions might actually trigger a rate hike at the September meeting.
Beyond the Fed minutes, here's what we should watch on the economic calendar to determine if this is just a healthy correction or a deeper, prolonged trend. Tomorrow, Thursday, August 20th, we'll get weekly jobless claims and the Philadelphia Fed Manufacturing Index, both arriving at 8:30 a.m. ET. Then, on Friday, August 21st, the S&P Global Flash PMIs for August will land at 9:45 a.m. ET.
The market is clearly at an inflection point. 2 days of heavy selling have brought sky-high tech valuations a lot closer to earth, but the tightening bond market continues to pressure financial conditions. So what does this all mean? The direction we take next depends entirely on the Federal Reserve's messaging in tonight's minutes. Thanks for watching, please subscribe, and hit the like button.
This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.